Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why retailer Target is naming an insider as its next chief executive officer.
Plus, we'll look at why the Danish drug maker Novo Nordisk is slashing the cost of its weight loss drug Ozempic.
But first, we begin with the earnings from TJX companies.
This week, the off-price retailer raised its full-year guidance and reported second-quarter earnings that beat analyst projections. It's a sign that shoppers are currently turning toward discounters due to economic uncertainty.
For more, guest host Alexis Christoforous and I were joined by Mary Ross Gilbert, Bloomberg Intelligence senior retail equity analyst. We first asked Mary for her take on the company's results.
TJX is hitting it out of the park. This is a company that just executes seamlessly and consistently, something in retail that's very, very difficult to do. They saw strength across all categories, across all income groups, all age groups, and they know how to get the merchandise right by store, by region. So they have a terrific planning and allocation. They sort of emphasize that. And another key point, because they raised their guidance not only for sales, but also on the margin side, and there was such a huge fear with tariffs, they only source probably less than 10% of their sales come from, or their merchandise is something they directly source. They were able to buy better, which means they got better deals. That means there's so much availability out there, and it's something we've observed in our channel checks. And when you look at the shopping hauls on television and on YouTube, and you see the incredible brands that are available, and they really are across good, better, and best. So you can get anything from Puma, Adidas, Nike, all the way up to Yves Saint Laurent and Gucci. So it's and TJX really wins across all that. So strength across all their channels and internationally. I mean, Canada was up 9% in comp sales.
I want to ask you about a possible headwind, though, because it seems like they're firing on all cylinders. But I know that TJX mentioned in the past about a key demographic, the Hispanic customer. They were concerned that maybe immigration policy was going to keep them home or not spend as much. Did they mention anything about that?
I don't think they saw any weakness as a result of that. I know it's been a big concern, not only for TJX, as you brought up, Alexi, but also for Ross and for Burlington, and probably even more so for Burlington because they really skew to a lower income consumer, and they're due to report next week, and so we should learn more on that.
Mary, I always think the job of a retail analyst like you is really tough because not only do you have to do the regular stuff as an analyst, like get the earnings estimates kind of right and all the financial analysis, but you kind of have to have an opinion on like who's good at picking out the right fashion to even put in the store in the first place. What is TJX doing so well, do you think?
Well, they have the most amazing buying team, and so they have sort of like a buying academy where they teach their buyers. They have to go through, I think it's like 3 years, maybe even up to 7 years of work that they do with these buyers. So the pricing that they work on and the product that they're buying is really something that is steeped in experience, history. They also invest in systems, so that means technology. logistics, to make sure that they can get this all right. Because you can imagine that if they're shipping multiple merchandise, you got to have fresh drops, because these customers will shop multiple times a week, because it's that freshness that brings them in. So yes, TJX is the leader. They're the largest in the world. I mean, they'll probably hit 60 billion in revenues this year, up from 56 billion last year. And they keep increasing the number of potential store openings they see. Previously, they said, we think we have another 1,200 stores to open. Now they're saying it's another 1,800 stores to open around the country, around the globe, in their existing markets. So yes, this company really has the expertise in doing it right.
Is there a digital strategy here? Because I remember, I'm sure you do too, Mary, when you would go online to try to find out what TJ Maxx had, and there was nothing there, because you always had to go in the store to find out what they had. I think they had to step up their game, right, because of Amazon and others online. But what is the digital strategy, if anything, at TJ Maxx and TJX?
That's a good question. So actually, TJX has a digital strategy. It's across all their brands except for home goods. And so it's about, I think it's just under 5% of sales, so it's very small. But they also saw strength in this quarter on their e-com business. So they do have an e-com business. You can go on it and you can shop anything you want on there. Now, you can't say that you want to shop by brand, but you can select, let's say that you want to just buy the ultra luxe, merchandise that they have there, and you'll see Christian Dior sunglasses. You'll see, like I mentioned, on the handbag size, Balenciaga. So you will be able to find what you want on the high end, also on the low end, but you'll have to do it by price points, by sorting that way, because they're not allowed to necessarily have that ability to sort by brands. So you will see they have a robust online business, and it's around the globe. Now, the key is that they're a key differentiator in that regard. Remember that it's still very small, and that the vast majority of their sales, more like 96% or so, are being generated in store. But nobody else in off-price, other than the rack, the Nordstrom rack, has e-commerce capabilities. All the rest, it's strictly a bricks and mortar model.
Our thanks to Mary Ross Gilbert, Bloomberg Intelligence Senior Retail Equity Analyst.
We move next to news from the cosmetics company Estee Lauder.
This week, the company issued a weak profit outlook for its fiscal year. Estee Lauder said it was weighed down by sluggish demand for high-end goods and an escalating trade war.
For more, guest host Alexis Christoforous and I were joined by Deb Aitken, Bloomberg Intelligence luxury goods analyst. We first asked Deb what she took away from Estee Lauder's earnings.
They're doing well out of the US, improving their numbers for the full year are still down, but you could see sequential improvement by end of year. And also somewhat less soft in China. But for them, where they still have so much exposure in Asia, and still particularly in travel retail, inventories to me still look stuffed, even though if I think about travel retail overall, it's 15% of their business now. It was near 30% 4 years ago, and they're losing about 4 points of growth annually. For me, when I look at the inventory data, over 200 days versus 190, it still says that there's risk there for me. So they need to right-size Asia. They need to do more in getting out of main stores in the US. They're doing a lot positively on things like Amazon Beauty and in Asia on TikTok, but it's all moving online. So it's a third of their business online. A lot going on, a lot of cost savings, cost cutting, and very low on margin, and that the company is actually taken away quarterly guidance. And forecast for EPS on the full year are 6 cents below the 2.16 is expected by consensus. 2.10 on guidance at the top end is already a little bit below. So shares are weak again on the back of a couple of years of underperformance.
Deb, definitely, as you just laid out, a few tough years for this legacy brand. But explain to me why there were some upgrades recently. I was surprised to see Deutsche Bank, HSBC upgrading from hold to buy. You got JPM upgrading to overweight. What do they see here that maybe others on Wall Street are not?
I think especially as we've headed through the last couple of quarters, you can see that there are share gains, market share gains in some categories in some countries. So Japan positively, some parts of China by the end positively, some categories in the US positively as well. And there are very easy comps that they will cycle through in the next year ahead. And certainly under the CEO and the CFO, there feels just a lot more momentum and energy to come. So I think that's what the market are buying into, as well as the underperformance that we've seen. But we must remember, in terms of them being competitive and what they're doing, they talk about a solid double-digit adjusted EBIT margin. It'll back their investment, and then being in front of the consumer, their innovation pipeline and others. They're only at 8% at the end of fiscal 2025, and they say they get to a double-digit adjusted EBIT margin over the next few years. That to me says there's still a bumpy ride. So I understand why those quarterly numbers have gone.
Right. Hey, Deb, Estee Lauder said the tariff's going to cost them about $100 million to profitability this year. What are some of the luxury companies, the brands that you follow, are they taking these tariff costs into their P&L? Are they trying to pass them along to customers? What's been the strategy so far?
Yeah, certainly for the very high end, we saw, even at the beginning of the year, pre-tariff announcements, the very high end, like Hermes would say, because of wage costs and others, we'll be looking at 5 to 6% price increases, started passing those through the beginning of the year. And then in May, when the spring summer collections came through, they then have commented generally for the luxury space, and from the work we've done, that some may need up to 4 or 5% price to be passed through. And the plan is that they pass most of it through. I don't think very much of it goes up or down the supply chain, and it's going to be done gradually in some categories, rather than some can clearly pass it through more visibly than others. And some will struggle more. And then we heard the news from Switzerland with the 39% tariff. So companies like Swatch for us will find it difficult. Companies like Estee Lauder, where it's not every brand that is resonating with the consumer, will find it difficult in some brands, in some categories. So that's why I think we wait quarter by quarter and across the rest of the year to see what companies do need to take a little bit of that on board. But most of them are finding cost cutting as part of that. And certainly on the gross, we did see for full year 40 basis points improvement on gross margin for Estee Lauder, with a little bit of that tariff impact mixed in there, and that they're expecting further gross margin improvement in 2026.
Our thanks to Deb Aitken, Bloomberg Intelligence luxury goods analyst. Coming up, a look at earnings from the world's largest home improvement retailer, Home Depot.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence. We move next to news from the merchandise retailer Target.
This week, Target named insider Michael Fidelki as its next chief executive officer. Shares of Target fell after the appointment, indicating that Wall Street had been hoping for an outsider to take over the company's leadership.
This all comes after the company reported second quarter earnings that only narrowly surpassed analysts' expectations. Target also maintained its outlook for the full year after slashing it a few months back.
For more, guest host Alexis Christoforous and I were joined by Jen Bartashus, Bloomberg Intelligence senior retail analyst. We first asked Jen for her take on the new CEO and whether Target should have gone with an outsider.
It's an interesting choice. I think there are investors for a little while now have been interested in seeing a CEO change. Brian Cornell has done a great job during his tenure, at least initially in terms of really driving growth for Target. But an internal choice really implies much of the same strategy. And I think there was some hopes that there would be something a little different to maybe shake things up and bring something new to the company.
You know, I'm wondering if Target is going through an existential crisis, right? Sort of this identity crisis. Because you feel like, I don't know about you, Paul, I know the last time you went into a Target.
Sure.
But you feel like they've lost their mojo, Jennifer, because the last time I was in there, the store shelves were not stocked very well, felt disorganized, couldn't find a sales associate to help me. What does this new CEO have to do to help this company get back on track?
Well, it's very interesting. He's highlighted 3 priorities, but they're not really new priorities. But if they can bring focus to it, maybe that will help. And that's, re-energizing the assortment, bringing back some of that style and, value that people crave. It's about having a very good, consistent in-store execution and experience, which is what you were actually just talking about. Having things in stock, having associates available, and then the third is an acceleration in the deployment of technology to maybe make processes faster, improve efficiency, that sort of thing. So we'll see if that if that happens. But it's really about getting back to what is it that consumers loved about Target, and how do you get them back in that frame of mind so that they come to stores and spend there.
Well, you're the expert here. I don't have a sense of what people go to Target for. What do you think they go to Target for?
Well, what they traditionally have gone to Target for was that sense of discovery, right? You had a couple of things on your list, you got in and you were inspired. You saw home decoration items that you just were like, oh, that would look great in my living room. Or you would go through apparel and you would see something very stylish and value that you thought, oh, that's a great thing to add to my basket. And so that's what's a little bit missing. And part of that may be because of just the rise in digital orders. It's a less conducive to those impromptu purchases, but it's also inspired by the assortment and by what people experience when they're in the stores. And that's really where they have to focus to get that magic back.
And Jennifer, correct me if I'm wrong. I think Target has more exposure to tariffs than, say, Walmart because of its mix of products. It doesn't have as much exposure to groceries as Walmart does, but it gets a lot of its products from overseas, places that are getting hit by these tariffs. How did that play out in this quarter, and how will it play out going forward?
Yeah, it's a great question, and it is one of the things that's sort of been bogging down Target. Ever since we've had very high food inflation, that willingness to spend on discretionary categories has been a little bit more limited, and that's really the area that Target has always excelled. Things like apparel and electronics and toys and home decor. And so, right now the company's saying they're doing a pretty good job of mitigating tariffs, but they are more exposed because of the merchandise mix that they have. So they said they've done some right sizing. They've paid off kind of the one-time cancellation charges they had while they were waiting on the tariff verdicts. We'll see what unfolds in third quarter, and especially because it's back to school, which is a really important quarter for Target.
I guess what's recently in the last 10, 15 years really amazed me about Walmart is how effective their digital strategy was. And they actually went toe-to-toe with Amazon, and I think they more than hold their own. Talk just about Target and their digital strategy. How's that performing?
Overall, Target's digital strategy has been doing pretty well. They've made a conscious decision to not go head-to-head with Walmart and Target. So, for example, in their marketplace, it's not just a endless aisle of sellers. They have a very close criteria of who they let onto their platform. And that's worked well for them because it helps keep the product selection closer to what people expect from Target. Their digital sales were up in terms of same-store sales this quarter, well outpaced the visits to stores. And so they've been executing pretty well there. It's just a matter of how do they marry the two parts of the business to grow simultaneously.
Our thanks to Jen Bartashus, Bloomberg Intelligence Senior Retail Analyst.
We move next to news from the world's largest home improvement retailer, Home Depot.
This week, Home Depot said sales returned to growth in the second quarter. This comes as shoppers invested in smaller projects such as lighting and gardening.
For more, Lisa and I were joined by Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst.
We first asked Drew for his take on Home Depot's earnings.
It was actually a pretty much inline quarter for Home Depot today. Comps up about 1%. A little shy consensus, but if you back out some of the Forex impact, it was pretty much in line. Now, of course, growth isn't as strong as you would like to see, and a lot of that, as you mentioned, has to do with where rates are, both rates on home equity loans and mortgage rates. You have to remember, housing turnover is at the lowest level since the financial crisis. And what we've heard consistently from Home Depot over the last several quarters is that consumers are pulling back on big ticket discretionary categories. So think of things like kitchen and bath remodels or flooring. And the reason is because these tend to be financed with debt, and with rates where they are and consumers with the expectation that rates are going to pull back, they're taking a wait and see approach and deciding to opt for those smaller ticket projects instead.
Drew, what does Home Depot say about tariff risk for them? How did they quantify it for the street?
Yeah, good question. Obviously on, top of mind for a lot of investors. So Home Depot has done well to diversify their sourcing over the last several years. They get about 50% of their products from the US, so they are in pretty good shape from that regard. We would estimate, products coming from China are somewhere around 15 to 20%. And there's a couple ways that they're going to manage this. One, given the scale that they have, they're able to push back against suppliers. The second, they continue to diversify their supply chain. On their last quarter call, they mentioned that no single country outside of the US will be more than 10% of sourcing. And then lastly, I think we're going to start to see some selective price increases coming through in the next several quarters. Now, they've done a little bit of pre-buy on the inventory side to make sure that they had some of that lower cost product on the shelves for consumers. But I think, as we get to the end of this year and into next year, you're going to start to see a little bit of pricing. Now, we wouldn't expect it to be widespread or significant. Remember, Home Depot sells about 30 to 40,000 products on their shelf. So they tend to take a portfolio approach and manage pricing really across the entire project rather than raising prices across the board.
Drew, so are you telling me my next Home Depot run is going to be more expensive? It's going to cost me more. Drew, I have painting, I have a deck to build, I have things to do. I mean, you're saying this could take effect pretty soon.
Well, maybe not your next trip,
okay,
but
the
next couple, maybe looking more towards the end of this year or into next year, we would expect to see prices up marginally.
So I need to rush now, is what you're saying. Well, if consumers are putting off those big projects, what are they focusing on? I mean, is it the smaller ones, or are they just canceling projects altogether?
Yeah, it tends to be more maintenance, repair oriented. So those projects around the house where things break and you have to fix them immediately, or replacement products for appliances and things of that nature. And again, what we're not seeing is the big ticket discretionary things like kitchen and bath that require financing.
Our thanks to Drew Redding, Bloomberg Intelligence, U.S. Homebuilding Analyst.
We move next to the medical device industry.
This week, the medical device company Medtronic reported profit that beat analyst expectations. The company also lifted its full-year earnings guidance.
This came after Medtronic announced that it will expand its board after Elliott Investment Management became one of its biggest investors.
For more, Lisa and I were joined by Matt Henricksson, Bloomberg Intelligence Senior Medtech Analyst.
We first asked Matt to bring us up to date on what is happening at Medtronic.
With the Elliott Management news, they reported that they have a significant stake in the stock, and they're going to plan to bring on 2 new board of directors. These are previous Medtech CEOs from back in history. And basically, they're looking to revitalize growth and capture efficiencies to, as they quoted in their earnings call, build oxygen for future growth. And so one of the things we saw in the quarter in the earnings today, there were some areas that had strong growth, strong momentum, but in their diversified portfolio, there were other areas that kind of, let's say, needed some tweaking.
When it comes to the board, who are some of the additions that are coming in because of Elliott Investment? And has Elliott disclosed the size of the stake?
As of now, I have not seen an actual size of what the stake is. Some of these, the board directors, they were former CEOs at Dentsply, so some medtech companies. They were also previously at Becton Dickinson. Other ones, they are able to come in with more of an operational background. And so being able to drive kind of that efficiency to be able to create the savings to be able to invest into their R&D programs.
All right, for the folks in front of the terminal, the ticker is MDT. And then you type in the ANR function to get the analyst rating. The street doesn't know what to do with this stock. 17 buys, 16 holds, and 1 sell. What's the confusion out there about this name?
The confusion.
I mean, it's medical devices. Everybody needs medical stuff.
Everyone needs medical devices. Medtronic has invested a lot of money into these home run type products, pulse field ablation, renal denervation. All these products are trying to disrupt a current market, either if it's atrial fibrillation, hypertension. If you hit a home run like you're doing with pulse field ablation, it is going to drive pulse field ablation. It's basically a way to ablate an area that's being affected by atrial fibrillation without using heat or without freezing. So that prevents kind of the damage to the tissue. If you hit home runs like that, you're going to have key growth drivers. Other products like renal denervation is taking longer for that growth to develop. So analysts, including myself, see all these products in the pipeline, get very excited about the potential for that growth to accelerate from, let's say, the 4 to 5% they're currently at to 6%. And then we're just still waiting for that execution of those commercialization of the products to get to that higher growth. Some analysts, as you see in the ANR, they are more bullish on when that will come up. Others are starting to say, wait a minute, we've seen this story before. And so they are waiting. It's a wait and see story for those analysts.
I noticed when we talk tariffs, they scaled back the impact of tariffs. So they lifted their full year guidance. Are you seeing that more from other companies in this space?
Yes. I would say the majority of the companies that have reported so far, Medtronic always reports because their July fiscal quarter end. All the companies that reported their June fiscal end had a similar thing where they cut it by roughly half of what they had predicted in the first quarter.
Our thanks to Matt Henricksson, Bloomberg Intelligence Senior Medtech Analyst.
Coming up, we'll look at sustainable aviation fuel and how it's breaking records from 2024.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney.
And I'm Lisa Mateo, filling in on Bloomberg Intelligence. We move next to news in the drug and pharmaceutical space. This week, the Danish drug maker Novo Nordisk announced it's slashing the cost of Ozempic for cash-paying patients.
The company said patients can now get Ozempic for $499 a month. That's about half of its U.S. list price through Novo's cash-pay pharmacy, NovoCare.
Novo is also partnering with the healthcare company GoodRx to offer Ozempic for the same price as pharmacies across the U.S. And this all comes after Novo's weight loss drug Wegovy received FDA approval to treat a serious form of liver disease.
For more, Lisa and I were joined by Madison Muller, Bloomberg Health Reporter. We first asked Madison for her take on Novo's recent breakthrough with Wegovy.
Novo Nordisk got approval for Wegovy, which is its weight loss drug to treat a liver disease called MASH. And this sort of is we've seen over the last couple of years so many studies come out to show the potential health benefits of these weight loss drugs beyond just the reducing the number on the scale. And we knew from studies that there was some benefit to the liver from taking these drugs. And so Novo was able to notch an approval for that, which helps one with insurance coverage. Wegovy and then Eli Lilly's drug Zepbound are still not super widely covered by insurance companies for weight loss, but having some of these other health benefits shown and proven in studies helps them convince insurers that they are worth covering. And so this gives them an edge against Lilly. Lilly's drug Zepbound is not approved yet for this indication. And so it gives them sort of a leg up there. And then it also gets, it sort of is another benefit for Novo because they've been struggling over the last year, just with Zepbound sort of making waves in the market and taking market share from Wegovy. This gives them a leg up there as well. And just with the tumultuousness of the last few weeks, they had a CEO ouster and a few other moving pieces. So this is good news for them, and we'll see. But it will maybe help them gain back some market share.
One of the issues for these weight loss drugs is the cost. And if you're not covered by insurance, they really are expensive. So by slashing the cost of Ozempic in half, does the company believe that's going to open up a big new vein of new customers maybe?
So it's interesting because if patients are on Ozempic, they are usually on it. It's a type 2 diabetes treatment, and usually that's covered by insurance.
Diabetes, but does it have a side benefit, I guess, of weight loss?
Yes. So, there are two different drugs, right? There's Ozempic, which is the diabetes drug, Wegovy. They both use the exact same active ingredient, which is semaglutide. Okay. Wegovy is a higher dose version. If you're on Ozempic, it's lower doses. So it's not quite as strong. But there is that weight loss side effect on both drugs. Previously, Novo actually did cut the cost of Wegovy down to about the same price, $500 a month, back in March. And now they are doing the same for Ozempic. But it's interesting because the question of whether or not this is going to expand access for more patients sort of remains to be seen because, again, if you have Ozempic, you usually are covered by insurance for it.
Now, something I also said, they're partnering in this article. It said with GoodRx to offer Ozempic Wegovy for the same price as pharmacies. But didn't Novo try the partnership thing with Hims and Hers, and that didn't work out so well?
Yeah. So Hims was one of several partners that Novo has sort of worked with over the last couple of months, again, to really make waves and get into this market or gain back market share because it's really lost ground to Eli Lilly. Hims was one of the companies that they partnered with. They've partnered with a couple of other telehealth companies, as well as CVS, to make this cash pay price more widely available. But this is the first time that they're dropping the price of Ozempic as well. So this partnership with GoodRx, any patient is essentially a coupon. Like any patient who goes to a pharmacy uses GoodRx is going to be able to get this cash pay price for Ozempic and Wegovy.
Mention the Hims and Hers, those compound drugs. How effective are they vis-a-vis the GLP-1s themselves? Because that would be if I were like Novo Nordisk, I spent all this money to develop it, that would be a bummer to see these guys come out.
And that's a really good question, actually, that question of how effective are these drugs, because that's the problem, is we don't know. There are studies that drug makers are required to do. They have to go through a lengthy FDA approval process to prove that their medications are safe and effective. Compounded drugs don't go through that same approval process. So there's no actual studies showing how effective those medications are. And it's a little bit of a gamble. I mean, we've seen patients losing weight on these compounded medications, and we haven't seen a tremendous amount of side effects that are really different from the branded medications. So the problem is just more that we don't actually have a lot of visibility into that compounded market and don't know how those drugs stack up to the branded medications.
Where does this all put Eli Lilly then? I mean, they already had the setback with the weight loss pill. So now we're hearing all this about Novo. Where does this put them? Yeah.
I mean, it's interesting. Like the two companies, I think last year, it was just, they were so red hot and there was like nothing, the expectations were sky high. There was really nothing that seemingly could bring them down. But now we're seeing a couple of stumbles. And I think that shows, again, how high the expectations are for this market. There's just no room for failure. But we'll see what happens next with Lilly.
When is the pill going to be available? 6 months, 12 months? A year,
sometime 2026. So they said that they're planning to file for FDA approval by the end of the year and then hopefully launch next year.
Our thanks to Madison Muller, Bloomberg Health Reporter.
Each week we look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport industries. This week we took a look at sustainable aviation fuel and how it's breaking records from 2024.
For more, Lisa and I were joined by Anna Davies, BNEF Head of Renewable Fuels.
We first asked Anna to explain the reason behind the record-breaking use of sustainable aviation fuel.
There has been an influx in attention and growth in the sustainable aviation fuel market. And this is basically a market to produce a jet fuel molecule, but not use fossil fuels. So usually they use biofuels instead of fossil fuels. So something like used cooking oil out of a fryer. You can clean it, purify it, upgrade it. And then you can make a hydrocarbon molecule like jet fuel from that oil. And it's a way to decarbonize a sector like aviation, which if you don't have these fuels, it's very hard to decarbonize because there's no real alternative to jet fuel, and jet fuel is so highly carbon emissions.
How efficient is this jet fuel, this renewable jet fuel?
So it is almost identical to fossil jet fuel.
Okay.
So in terms of, it works the same way. You burn it in an aircraft engine. It releases CO2 like fossil jet fuel does. But the main thing is that it's from a plant or some other renewable source. And so if you think of agriculture, they absorb carbon dioxide for photosynthesis. And so therefore, you can think of it as sort of a net CO2 neutral-ish technology because it at least absorbs some CO2 in the growing of the fuels.
So are there any challenges with renewable jet fuel?
There's a lot of challenges. Okay. And the main challenge is cost. It's very costly. So the cheapest way to make these fuels is kind of what I've been describing. You take an oil, like use cooking oil. That alone is at least 2 to 4 times the cost of fossil jet fuel. And that one is tough because there's only so much used cooking oil out there. You can use other oils like soybean oil, but that has fewer emission benefits associated with it because then you're growing soybeans to cultivate further oil. So you have land issues, you have, all the pesticides and fertilizers and emissions that come from agriculture with that.
Who makes this stuff?
It is mostly the oil refineries these days.
Really?
Because they can utilize existing oil refineries and upgrade them to handle a bio oil. similar to a fossil oil. The process for making it becomes quite similar. So your largest producers are things like Neste, or here in the US, Phillips 66, and Valero have some pretty big operations.
Now, you talked about 2025 numbers, right? How do you compare that to 2024? Like, was it a significant jump?
Yeah, so this was a really big, 2025 number so far is on track to double 2024 numbers of production of this fuel in the US. 2024 was a quadrupling of 2023 volumes. So these are really growing at a quick rate. That said, it's growing from a very small number. So even with this quadrupling and doubling, we're still at less than 0.5% of all US fossil jet fuel, or less of all US fuel.
So it seems to me this is probably one of those supply and demand situations. I need demand to ramp up production to bring down the unit costs here. So what are the airlines committed to taking this fuel?
This is definitely a chicken and egg scenario. The airlines have targets in place. A lot of them want to have 10% of their fuel being SAF, sustainable aviation fuel, by 2030. But these are just targets. There's no real ramifications if they don't meet it. Some countries, like the EU and UK, are setting very strict mandates. So both of those regions have 2% mandates for SAF use in 2025, and that increases over time, and there are penalties associated with it if they don't meet that. Here in the US, we're definitely taking the incentive approach by offering tax incentives or other policy incentives to try and encourage production. There's no strict target.
Now, what about looking longer term? Like, is the outlook for this as it's been on this trajectory, you're saying, but can it continue this?
So that is a really good question. The countries like the EU and UK have very ambitious targets. The EU wants to see 70% of all jet fuel be made from sustainable aviation fuel by 2050. We at BNEF think that that's going to be very hard to achieve, just to produce that quantity of these fuels. Where would you get the feedstock from? Who would shoulder the cost of that? So we anticipate it'll probably be closer to sort of the 10% by 2050. 2030 is another time. There's a lot of targets. Like I said, airlines have 10% by 2030. We don't think that will be achieved either, just because a lot of projects have been delayed or canceled in recent years, especially as interest rates are high. Policies have been changing. There's a lot of uncertainty, especially here in the US, where a lot of these facilities are being planned. So there's been a lot of slowdown and delay in this industry. And the 2030 might be a time where we see really ambitious targets and not enough supply to meet it.
I'm a little reticent to ask this question, but how has this current administration impacted the adoption of SAF, these
aviation fuels? Yes. You can't talk about aviation fuel without talking about policy. This current administration, aviation fuel is something that they've permitted. They've allowed policies. There was a tax incentive in the Inflation Reduction Act to continue. They've done a few tweaks, though, that really changed the game for the industry. The first is that they are really promoting domestic production ahead of decarbonization. Mm-hmm. So things like U.S. crops now fare better relatively than, say, imported used cooking oil. The other challenge is they've sort of shifted the incentives a bit, so now it's a lot cheaper to produce the counterpart, which is road fuel, renewable diesel, for trucking than it is for sustainable aviation fuel. They're produced in the same method. It's a tad costlier to make jet fuel over diesel just by the mechanics of how it's produced. So the Inflation Reduction Act offered more of a tax credit for jet fuel, making the economics kind of more on par. They've sort of reduced that leg up, so we expect more diesel, less jet fuel in the coming years.
Our thanks to Anna Davies, BNEF Head of Renewable Fuels. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Lisa Mateo.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.